Hello and welcome to Boni's Life, where we cut through the noise and deliver the crypto insights you actually need. I'm Boni, and if you're watching this, you're probably wondering the same thing I am. Is this the calm before the storm, or are we just stuck in crypto purgatory? Well, buckle up, because this week is absolutely loaded with market-moving events that could send Bitcoin either soaring past $100,000 or tumbling back to test that $80,000 support. And trust me, you don't want to be caught on the wrong side of this trade. Let me set the stage for you. As of January 11th, 2026, Bitcoin is trading at $90,611, essentially flat over the last 24 hours. The total crypto market cap stands at $3.18 trillion, with Bitcoin maintaining its dominance at 56.9%. Ethereum is holding steady at $3,091, up a modest 0.1% in the last day, but showing some relative strength with a 1.6% gain over the past week. Now, these numbers might seem boring on the surface, but beneath this calm exterior, there's a pressure cooker of forces building that could explode at any moment. The past week has been a masterclass in consolidation. After Bitcoin's spectacular rise to an all-time high of $126,199 back in October 2025, we witnessed a brutal 36% correction that took us down to $80,600. That's right, folks, from euphoria to fear in a matter of weeks. But here's where it gets interesting. The market found strong support at that $80,000 level, and we've seen a relief rally of about 17% that took us up to $94,588. Since then, Bitcoin has been trading in a tight range between $84,000 and $94,000, and volumes have been declining. This is textbook consolidation, and for those of you who've been in this game long enough, you know what consolidation often precedes: a big move. Now let's talk about what makes this consolidation so fascinating. According to technical analysis from Zepe's latest report, this current price action is remarkably similar to the consolidation we saw in April 2025, right before Bitcoin went on its record-breaking run. History doesn't repeat itself, but it sure does rhyme. The relative strength index is sitting at 48.5, which is perfectly neutral. We're not overbought, we're not oversold. We're in that Goldilocks zone where the market could break in either direction with the right catalyst. And guess what? We've got catalysts coming this week that could make or break this consolidation. Let me break down the technical picture for you in detail. Bitcoin is currently testing a key order block between $89,200 and $90,500. This is where buyers have historically stepped in, and it's the first major support zone. If we hold above this level, the bulls are in control. But if we break below it, we could see a quick move down to test $85,000. On the upside, the immediate resistance is at $94,500. This level has rejected Bitcoin multiple times over the past few weeks. A clean break above this level, especially on increasing volume, would be a strong signal that we're ready to challenge the psychological $100,000 barrier. What's particularly interesting from a derivatives perspective is that as Bitcoin dipped from $92,000 to $90,000, open interest actually rose sharply. According to CoinGlass data, total open interest in Bitcoin futures stands at $61.28 billion. The increase in open interest during a price decline suggests that traders are adding short positions. This is actually bullish in the medium term because it sets up the potential for a short squeeze. If Bitcoin breaks above $94,500, all those shorts will need to cover, adding fuel to the rally. Speaking of CoinGlass, let's look at some other key metrics that paint a picture of market health. Total liquidations over the past 24 hours were just $62.59 million, down a massive 70.92% from the previous period. This is significant because it tells us that the market has stabilized. When liquidations are high, it means traders are getting caught offside and forced selling is amplifying moves. Low liquidations mean the market is more stable and less prone to cascading sell-offs. The long-short ratio among top traders on Binance is 2.4 to 1 in favor of longs, meaning professional traders are positioned for upside. However, this ratio has declined slightly from 2.57, suggesting some profit-taking or position reduction. Now let's shift our focus to Ethereum because ETH has been showing some interesting divergence from Bitcoin. Ethereum is currently trading at $3,091, and it's been consolidating in a range between $2,950 and $3,300. After making an all-time high of $4,956, Ethereum experienced a painful 39% correction that took it down to $3,054. The asset briefly broke below this range and made a low of $2,623. But importantly, it did not close below the 61.8% Fibonacci retracement level at $2,725. This is a critical technical level that often acts as a last line of defense before a deeper correction. What's fascinating about Ethereum right now is the order flow data, the cumulative volume delta, which measures the net difference between market buy and sell orders, has been trending higher across both spot and futures markets over the past 3 weeks. This indicates that aggressive buyers are stepping in and driving price action. However, and this is a big however, the positioning by size of trader tells a different story. Whale wallets, those holding between $100,000 and $10 million, recorded a negative $40 million cumulative delta this week. That's net selling. Meanwhile, retail traders and mid-sized participants posted positive deltas of $3.4 million and $28 million, respectively. So what does this mean? It means that Ethereum's recent recovery is being driven primarily by smaller participants, not by the big institutional money. This is something to watch closely because sustained rallies typically need whale participation. The next major test for Ethereum is to reclaim its 200-day exponential moving average. This is a critical level that separates bull markets from bear markets in the eyes of many technical traders. A sustained break above this level could encourage larger players to re-enter, potentially triggering a more significant rally. On the flip side, failure to break above this level could result in more consolidation or even a retest of the lower end of the range at $2,950. Now let's talk about the elephant in the room, the macroeconomic environment, because as much as we'd like to believe that crypto operates in its own universe, the reality is that it's deeply interconnected with traditional financial markets. And this week, we have a series of economic data releases that could have a profound impact on crypto prices. The big one is Tuesday, January 13th, when the US Consumer Price Index data is released at 8:30 p.m. GMT +7. This is the most important inflation indicator, and it will heavily influence the Federal Reserve's thinking on interest rates. The market is expecting a 0.3% month-over-month increase in core CPI, which excludes food and energy, and a 2.7% year-over-year increase in headline CPI. Now, if the numbers come in hotter than expected, say 0.4% or higher, it would signal that inflation is proving stickier than anticipated. This would likely lead to a reassessment of Fed rate cut expectations, potentially pushing rate cuts further into the future. And that would be negative for risk assets like crypto. On the other hand, if CPI comes in at or below expectations, it would reinforce the narrative that inflation is under control and that the Fed has room to cut rates. This would be bullish for crypto. As James Butterfield from CoinShares noted in his recent forecast, risks such as inflation shocks or policy errors from the Fed could drive demand for alternative non-sovereign monetary assets like Bitcoin. In other words, if the Fed gets it wrong, Bitcoin could benefit as a hedge, but Tuesday's CPI isn't the only data point to watch. On Wednesday, January 14th, we get the Producer Price Index, which measures inflation at the wholesale level, and retail sales data, which gives us insight into consumer spending. The forecast for core PPI is 0.2% month-over-month, and for retail sales, we're expecting a 0.4% increase. Strong retail sales would signal a healthy consumer, which is generally positive for risk assets. But if retail sales disappoint, it could signal economic weakness, which might paradoxically be bullish for crypto if it leads to expectations of more aggressive Fed easing. Thursday brings us the weekly unemployment claims data, with a forecast of 210,000 claims. This is a high-frequency indicator of labor market health. A spike in claims would signal labor market weakness, while a decline would signal strength. The Fed has made it clear that they're watching the labor market closely, so this data point matters. Beyond these specific data releases, there's a broader uncertainty hanging over the market, the transition in Fed leadership. Fed Chair Jerome Powell's term ends in May 2026, and the appointment of a new chair could bring a significant shift in monetary policy. According to analysts at CoinShares, the new chair is likely to be dovish, meaning more inclined to cut rates and provide monetary stimulus. But until we have more clarity on who that person will be and what their policy stance is, there's going to be uncertainty. and markets hate uncertainty. Now, let's talk about something that's decidedly not uncertain: the wave of institutional adoption that continues to sweep through the crypto space. Just last week, Morgan Stanley filed for its own Bitcoin, Ethereum, and Solana exchange-traded funds. Let that sink in for a moment. Morgan Stanley, one of the most prestigious names in traditional finance, is launching crypto ETFs. This isn't some small fintech startup or crypto-native company. This is Wall Street royalty. Jeff Park, who serves as investment chief at ProCap BTC and as an advisor to Bitwise, had a brilliant take on this. He said, and I quote, "Bitcoin is socially important just as much as it is financially important as a product to offer to customers. Every asset manager knows that having a Bitcoin ETF communicates that they are forward-thinking, young, and a little edgy." He went on to say that Morgan Stanley is making the bet that even if their ETF doesn't scale to blockbuster success, there's an intangible benefit that will help build their clout. This is about more than just money. It's about cultural relevance, and the numbers back this up. More than $100 billion is already parked across some 14 US Bitcoin ETF funds, according to data from DeFi Llama. BlackRock's iShares Bitcoin Trust leads the pack with a staggering $67 billion in assets under management. And here's the kicker: Bitcoin ETFs have enjoyed nearly $1 billion in net inflows in just the first week of 2026. After 2 consecutive months of outflows totaling over $4.5 billion in November and December, this reversal is significant. It suggests that institutional appetite for Bitcoin exposure is returning. The ETF flow data tells an interesting story. On January 2nd and 5th, we saw strong inflows of $5.31 billion and $7.62 billion respectively. But then we had 4 consecutive days of outflows from January 6th through 9th. However, the overall trend for the first week of 2026 is positive, with over $1.1 billion in total net inflows. This suggests that while there's some profit-taking and portfolio rebalancing happening, the underlying demand remains strong. What's particularly interesting is the commentary from Standard Chartered's Jeff Kendrick, who is the bank's global head of digital asset research. Kendrick recently revised his Bitcoin price target for 2026 from $300,000 down to $150,000. Now, before you panic, let me explain his reasoning. Kendrick noted that buying by Bitcoin digital asset treasury companies, or DATEs, is likely over, as valuations no longer support further DATE expansion. These are companies like MicroStrategy that have been aggressive buyers of Bitcoin. Kendrick expects consolidation rather than outright selling from these players, but he doesn't expect them to provide the same level of buying support they did in the past. Instead, he believes that future Bitcoin price increases will be driven primarily by ETF buying. And with Morgan Stanley now entering the ETF space, that buying power is only going to increase. Let me share some other expert perspectives that are shaping the narrative for 2026. Carol Alexander, a professor of finance at the University of Sussex, expects Bitcoin to remain in a high volatility range between $75,000 and $150,000, with the center of gravity around $110,000. She attributes this to the market digesting a transition from retail-led cycles to institutionally distributed liquidity. Historically, Bitcoin's price has been driven by retail traders, but over the past 2 years, institutional investors have become increasingly important. This shift is still playing out, and it's creating volatility as the market finds a new equilibrium. James Butterfield from CoinShares has a slightly more bullish view, expecting Bitcoin to trade in a range between $120,000 and $170,000 in 2026, with more constructive price action likely in the second half of the year. He's particularly focused on regulatory developments, noting that the Clarity Act, which seeks to create a framework for regulating digital assets, could be a meaningful catalyst if it becomes law in 2026. Regulation has been a persistent overhang on the crypto market, and resolution of this uncertainty could unlock significant capital. Sidney Powell, CEO of Maple Finance, has a price target of $175,000 for Bitcoin this year, driven by interest rate cuts and increasing institutional adoption. He made an interesting point about Bitcoin-backed lending, predicting that when Bitcoin-backed lending exceeds $100 billion, it will be a major milestone. His reasoning is that Bitcoin holders are becoming increasingly sophisticated and don't want to sell their BTC. They want to borrow against it, This creates a virtuous cycle of less selling pressure, more utility, and higher prices. On the more cautious side, Yue Yang, chief economist at Bitmining, is predicting a wide trading range for Bitcoin in 2026 of between $75,000 and $225,000. That's a massive range, reflecting the high degree of uncertainty. Yang noted that 2026 could be a strong year for Bitcoin, supported by potential rate cuts and a more accommodating regulatory stance toward crypto, but he expects heightened volatility amid ongoing macroeconomic and geopolitical uncertainties. So, with all of this context, how should you be trading this market? Let me walk you through several strategies that are appropriate for different risk profiles and time horizons. Strategy number 1 is range trading, which is appropriate for conservative traders. The setup is simple. Bitcoin is trading in a well-defined range between $84,000 and $94,000, and Ethereum is in a range between $2,950 and $3,300. The strategy is to buy near the bottom of the range and sell near the top. For Bitcoin, that means looking for long entries around $85,000 with a stop loss below $84,000 and targeting $92,000 to $93,000 for profit taking. On the short side, you'd be looking to enter around $93,500 with a stop above $95,000, targeting $86,000 to $87,000. The key to successful range trading is discipline. You need to be willing to take your profits when you hit your targets and cut your losses quickly if the range breaks. Strategy number 2 is breakout trading, which is more aggressive. This strategy involves waiting for a confirmed breakout above or below the current range before entering a trade. For Bitcoin, a breakout above $94,500 on high volume would be a strong bullish signal, potentially targeting $100,000 and beyond. The key word here is confirmed. You don't want to chase a false breakout. Wait for a candlestick close above the breakout level, ideally with a volume increase of at least 30%, and then enter on a retest of that level. Your stop loss would be just below the breakout level, around $93,500. On the downside, a break below $84,000 would signal a deeper correction, potentially targeting $80,000 or even $75,000. Again, wait for confirmation and enter on a retest with your stop just above the breakdown level. Strategy number 3 is event-driven trading, which is centered around the major economic data releases this week, particularly the CPI data on Tuesday. This is a high-risk, high-reward strategy that's not for everyone. The approach is to reduce your positions before the data release to minimize risk, then wait for the initial volatility to subside, typically 30 to 60 minutes after the release. Then you enter a trade based on the market's reaction. If CPI comes in hotter than expected and Bitcoin sells off, you might look for a short entry once the selling stabilizes. If CPI comes in cooler and Bitcoin rallies, you'd look for a long entry on a pullback. The key is to use wider stop losses to account for the increased volatility and to reduce your position size compared to your normal trades. Strategy number 4 is the accumulation strategy, which is for long-term investors. This involves dollar cost averaging into positions during periods of consolidation and fear. The current fear and greed index reading of 30 indicates we're in fear territory, which historically has been a good time for long-term accumulation. The strategy is to split your capital into 4 or 5 tranches and deploy 1 tranche per week, focusing on the major cryptocurrencies like Bitcoin and Ethereum. For Bitcoin, you'd be looking to accumulate in the $85,000 to $88,000 zone. For Ethereum, the $2,950 to $3,050 zone looks attractive. Your time horizon should be 3 to 6 months, and you should be targeting returns of 30% to 50% from your average entry price. The key is to be patient and not panic if prices dip further in the short term. Now, let's talk about risk management, because this is where most traders fail. No matter which strategy you're using, you need to have clear rules for position sizing and stop losses. A good rule of thumb is to risk no more than 1% to 2% of your total portfolio on any single trade. This means if you have a $100,000 portfolio, you should be risking $1,000 to $2,000 per trade. Your position size should be calculated based on the distance to your stop loss. For example, if you're buying Bitcoin at $90,000 with a stop at $88,000, that's a $2,000 risk per Bitcoin. If you want to risk $1,000 total, you'd buy 0.5 Bitcoin. Another critical aspect of risk management is diversification. Don't put all your eggs in one basket. Even within crypto, you should be diversified across multiple assets. Bitcoin and Ethereum should form the core of your portfolio, but you can also allocate a smaller percentage to high-quality altcoins like Solana, which is currently trading at $136 and showing some interesting technical patterns. Let's talk about some specific risk factors you need to be monitoring this week. On the macro side, the biggest risk is that CPI comes in significantly hotter than expected, leading to a repricing of Fed rate cut expectations. This could trigger a sell-off not just in crypto but across all risk assets. Another risk is weak retail sales data, which could signal economic weakness and lead to a flight to safety. On the crypto-specific side, continued ETF outflows would be a red flag, suggesting that institutional appetite is waning. We also need to watch for any regulatory surprises, particularly around the Clarity Act. On the technical side, a failed breakout above $94,500 would be bearish, potentially trapping bulls and leading to a quick reversal. Similarly, if we break below $85,000, it could trigger a cascade of stop losses and lead to a rapid move down to $80,000. The declining volume during this consolidation is also a concern because it suggests a lack of conviction. Ideally, we'd want to see volume increasing as we approach a breakout, which would signal that there's real buying or selling pressure behind the move. Now, let's look at some of the altcoins that are worth watching this week. Solana has been consolidating in a range between $120 and $145 after a brutal 53.5% correction from its high of $253.50. The asset is taking strong support at $120 and is trading in what technical analysts call a descending channel pattern. A breakout above $145 on good volume could signal that the worst is over for Solana and open the door to a move back towards $165. On the downside, a break below $120 would be concerning and could lead to a test of the $100 level. Other altcoins showing interesting patterns include Cardano, which is trading at $0.39 and has been consolidating after its own correction. The key level to watch for Cardano is 42 cents. A break above this level could signal a move towards 50 cents. For those interested in the DeFi space, Aave is trading at $165.80 and has been showing relative strength. A break above $175 could target $200. Before we wrap up, I want to address a question I get all the time. Boni, should I be in crypto right now or should I wait? Here's my honest answer. If you're a long-term investor with a time horizon of at least 6 months to a year, I think the current levels present a reasonable entry point. We're 30% below the all-time high, institutional adoption is accelerating, and the regulatory environment is improving. Yes, there's short-term uncertainty around economic data and Fed policy, but that's always the case. If you're a short-term trader, you need to be more tactical. Wait for clear signals, use proper risk management, and don't try to predict the unpredictable. One more thing I want to emphasize: the importance of staying informed and adaptable. The crypto market moves fast, and what's true today might not be true tomorrow. That's why you need to be constantly updating your analysis and being willing to change your mind when the facts change. Don't fall in love with your positions. If the market is telling you you're wrong, listen to it. So, to summarize, we're at a critical juncture in the crypto market. Bitcoin is consolidating in a tight range between $84,000 and $94,000, building energy for a significant move. The technical indicators are neutral, with the RSI at 48.5 and declining volume suggesting indecision. Ethereum is showing some relative strength, driven by smaller traders, but whale selling is a concern. The derivatives market is showing signs of stability, with liquidations down sharply and open interest steady. On the fundamental side, we have a packed week of economic data, with CPI on Tuesday being the main event. The market is expecting inflation to remain elevated but stable. Any surprise to the upside or downside could trigger significant volatility. Institutional adoption continues to accelerate, with Morgan Stanley's ETF filing being the latest sign that crypto is going mainstream. Expert opinions are mixed, with price targets for Bitcoin in 2026 ranging from $75,000 to $225,000, reflecting the high degree of uncertainty. From a trading perspective, there are strategies for every risk profile. Conservative traders can focus on range trading, aggressive traders can look for breakouts, and long-term investors can use this consolidation period to accumulate. The key is proper risk management, diversification, and staying adaptable. This week is going to be exciting and potentially volatile. Make sure you're prepared, have your trading plan in place, and stick to your rules. And remember, in crypto, the only constant is change. Stay informed, stay disciplined, and most importantly, stay curious. And thank you so much for watching Boni's Life. If you found this analysis helpful, please give this video a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next episode. Drop a comment below and let me know what you think about the market right now. Are you bullish, bearish, or just confused? I read every comment and I love hearing from you. Until next time, trade smart, manage your risk, and remember, in the world of crypto, knowledge is your greatest asset. This is Boni, signing off.